All right. Hi, everyone. Thanks for joining me this early in the morning. Really excited to be here and chat about how to tame and untangle your crypto tax and accounting activity on Ethereum. Okay, first, here's our agenda. I'll give you a quick intro to myself and my company, Hashbasis. Then we'll talk about some first principles of crypto tax and accounting. Finally, we'll dive into my favorite part, which is going through all the different activity on Ethereum, mostly the most popular ones. And then finally, I'll go into how to set up a crypto subledger. All right, but first off, hi everyone, I'm Mackenzie Patel. I'm the CEO and partner of Hashbasis, your crypto native accounting firm. I got my start in crypto accounting by working at Figment, which is a proof-of-stake validator on over 60 different blockchains. Prior to that, I was doing revenue accounting at Honeywell, and before that, I was studying accounting at the University of Florida. And so my business partner, Courtney, who is also there, and we worked together at Figment, we wanted to bring our accounting and tax skills, as it applies to crypto, to the broader ecosystem because we noticed that there was a general lack of accountants in this area. All right, but first I just want to touch base on some first principles of crypto tax and accounting. And this is not financial advice, so disclaimer. Okay, so the way this presentation is structured is I split it between the tax treatment and then the accounting treatment for whatever Ethereum activity I'm talking about. So just want to give a primer. So let's start off with the tax side. So tax code is governed by the IRC, Internal Revenue Code. Basically, the IRS puts out this code and tells you how to tax certain transactions. And so the most important thing to know about how crypto is taxed is that crypto is actually treated as property. So if you think of your house or an apartment building, which is also property, the same rules that apply to that also apply to crypto, which I find to be interesting because an apartment building is physical property. And so any income that applies to your digital assets is either characterized as ordinary or as capital income. And so you might hear in tax lingo it's called the character of income. That's just what's referring to, ordinary or capital. And so a really important related concept is cost basis. You probably have heard that a lot in context of crypto. And so cost basis basically just means what's the price at which you first originally acquired your digital asset. Now, on the not so fun part, we have some taxable events here. And so the most basic one is basically just any cents of crypto. Not in the ones that are non-taxable, we're going to exclude those for a minute, but basically any sends of crypto, so if you're sending it for interest expense or sending to pay for a contractor, basically any send is going to be taxable and give rise to a capital gain or a capital loss. Down beneath that, we have any trading, swapping, exchanging. They're all kind of synonymous, mean the same thing, but any trades, let's say I'm trading wrap Bitcoin for wrap ETH, that's an exchange that is taxable, and that is capital gain or capital loss. Now, on the income side, we have mining or staking income. So let's say you run an ETH validator on the Beacon chain and you're earning staking rewards. That is treated as ordinary income and is taxable. And then finally, any airdrops or forks. So that ENS airdrop everybody got a few years ago, that was taxable as ordinary income. And now let's move on to some more fun stuff, which is the non-taxable events. So anytime you buy crypto through an exchange, that's non-taxable, but the caveat there is you have to pay with fiat. So let's say I take my bank account, I hook it up to Coinbase, I buy some ETH. That's actually non-taxable, which is great. And then also donating, that's a fun one. So if you donate crypto, it's non-taxable. There's a lot of different caveats to that. So you have to donate to a 501c3 registered charity in order for it to count. And there's also phase-outs and limitations. Another note on that is that there's only really a tax advantage if you itemize your deductions. If you take the standard, then donating doesn't really apply as much. Any internal transfers, so if I got crypto, I've got some ETH in my MetaMask, I'm transferring it over to a ledger, that is non-taxable. Just think of transferring money between two bank accounts. And then also gifting is non-taxable, which I think is pretty cool. So you can gift up to $16,000 per person per year, and it's non-taxable. So if I'm gonna give my mom some ETH up to 16K, I can just do that, and it's non-taxable. And so you'll also probably hear the term holding period a lot as it applies to crypto. And so basically that means, let's take long term. So if you hold your crypto for longer than a year, and let's say you sell it, there's a capital gain, you're actually eligible for capital gains rates, and they're called more preferential rates, and they're either taxed at 0, 15, or 20%. Contrast that to crypto you hold for short term, so less than a year, any income is going to be taxed at ordinary rates. And when I say ordinary, just like think of those tax brackets that your normal W-2 income is taxed at. They just tend to be a little bit higher than your preferential rates. Okay, so that's the tax side. I want to hop over to the accounting side real quick. And so accounting rules are governed by US GAAP, stands for Generally Accepted Accounting Principles. Basically, it's the rules that accountants have to follow. And this more applies to entities. So like public companies are going to follow US GAAP in the US. So under US GAAP, digital assets are actually treated as intangible assets. So think of like intellectual property or goodwill, any sort of branding. Basically, assets you can't really touch, those are intangible assets. And under US GAAP, digital assets are treated as intangibles. Now, the kicker there is that intangibles under US GAAP are subject to impairment tests at least once a year. And basically, that means that you have to always write your crypto assets down to the lowest price that they were basically ever in the time that you held them. So let's say you bought some ETH at $1,000, the cost basis is at 100, but the price tumbles to like 600 and then like 400 and then 200. You basically have to write your assets down all the way to 200, recognize an impairment expense, and you can't ever write that back up. Now, US GAAP will likely change with regards to that. They call it like a fair value treatment this year, so that is changing, but that's right now what the rules are. And then just want to touch base real quick on like assigning cost basis methods. So you might have heard of LIFO or FIFO or HIFO. Spec ID, there's a bunch of them, but it's just a way to assign a unit of cost basis to your digital assets that are leaving. And just note that that applies to both tax and GAAP. Okay, so enough of that lecture. I want to get into some fun stuff. So basically, I'm giving a high-level overview of some of the most popular activity on Ethereum and what the tax implications are, and then what the accounting implications are. So we're going to start off pretty simple. I call this like easy activity. And so I'm going to start with simple sends and simple receives. And so simple send, I'm just sending crypto. The example I have here is that I'm sending USDC to a contractor. Let's say that she performs some developer services for me. And so under the tax side, this is going to give rise to some capital gain or loss because I'm sending crypto, which is taxable. And so on the tax side, you really have to break it down between two different pieces. So the first one is called fair market value, FMV for short. Basically, what's the current value of the crypto that you're sending? So amount of crypto you're sending times the current price. And then you need to look at what's the cost basis of this crypto. So at what price did you originally acquire this crypto at? And chances are they're going to be different. So you take your current price, which is fair market value, minus the cost basis, which is like the original price, and that difference is going to be a capital gain or loss. Now with stable coins, there likely won't be a lot of gains or losses because it theoretically should be pegged to the dollar. But if you have a non-stable coin, like Flow or Near or something, there might be like dramatic fluctuations in that, and you might have a pretty large capital gain or loss, which is taxable. On the accounting side, I just have a bunch of journal entries because I think in journal entries. And so if you send something that's going to give rise to an expense, so debit expense, and then I'm disposing of some assets, some crypto assets, so I'm crediting them at the cost basis. And then, again, that difference is going to be gain or loss. Now, on the flip side of that, we have simple receives. So let's say I'm that developer, I'm getting my USDC back, and so that's actually ordinary income to me because I performed a service and I'm getting paid for it. And so it's just ordinary income at the fair market value, so the current price at the time that I received it. And then the journal entry is just increasing digital assets, and I'm increasing income. Now, a little bit more complicated than this is wrapping and bridging. So an example of wrapping, let's say I've got some Bitcoin on the Bitcoin blockchain, and I want to move it over to Ethereum. I can deposit it into a contract, and then I get WBTC or wrapped Bitcoin back. That's wrapping. Example of bridging, I have AXL USDC up here. That's a stable coin on the Axelar network. I can actually bridge that over to Ethereum and have my stable coin on Ethereum. And they act very, very similarly. And so under the more conservative view, this is actually considered a trade, which would give rise to a capital gain or loss, because I'm putting one asset in, let's say Bitcoin, I'm getting another asset back, wrap Bitcoin. That's an exchange, and that is taxable. Now, again, that's more conservative. There's a lot of gray areas around this per the IRC, so you could always take a more aggressive position, but that's the more conservative one. And then on the accounting side, we just have the journal entry for that. Okay, so a step up in levels of complication is DEXs. So I'm going to use Uniswap as an example here, and I'm specifically talking about any swapping or trading activity. So I have an example, because I thought that would be more fun. So we have CryptoPunk Courtney. She has 5 ETH, and they're worth $5,000. And so the fair market value is $1,000 per ETH. But she originally bought the tokens when ETH was $200. So her cost basis in each of the ETH is $200. And then no fees incurred on the original purchase. Now let's say Courtney was to swap 4 ETH on Uniswap for 10,000 GRT or graph tokens, and it costs 0.01 ETH to execute this swap. Now, what does this look like from a tax and accounting perspective? So on the tax side, you want to break it down. So on the first side, you think about what's the fair market value? Like, what's the current price of this trade that's going on? And so I break it down into first proceeds from sale. And so we sold 4 ETH for $1,000 each, which is the current price. And so the current proceeds from the ETH, $4,000. Now, the cool part about crypto tax is that you can actually take the gas fee that was incurred and add it to the overall fair market value of the trade. And so fair market value, the gas fee is just 0.01 ETH times $10,000. And so your gas fee, the current price is $10. And so basically what happens is that the cost basis of the new assets that were acquired, so the cost basis of the GRT, is basically the fair value of the ETH that was disposed. And so now we have the cost basis of GRT, $4,010, which is just the 4,000 plus 10. So okay, that's the fair market value side of it. Now we have to look at, okay, what's the cost basis of the digital assets that I disposed of? And so Courtney, she bought it when it was $200, so my cost basis is 4 ETH times $200 equals $800. That's my cost basis. Now where the gain comes into play here, I take the fair market value, which is at 4,010, minus the cost basis of 800, and that's our gain, 3,210 taxable at capital gains rates. So that's how it works on the tax side. The accounting side is pretty much the same. I just have it in journal entry format. Okay, so in interest of time, I'm going to go ahead and skip that. But I really want to get into liquidity providing because I think it's really interesting, and I'm using SushiSwap as an example here. And so I basically broke down the different steps of liquidity providing just because it makes it easier to identify from a tax and accounting perspective. Okay, so step 1, I'm depositing a pair of assets into a pool, and then I'm receiving an LP token back in exchange. And take note of that phrasing I just used. Now, step 3, because I'm a degen, I want to earn more rewards. I'm going to stake my LP token, and that's going to accrue some rewards. Maybe it's a governance token. Basically, I'm earning more tokens. And then step 5, I'm done with this. I want to unwind. I want to exit my position. I'm going to unstake my LP token and receive my original pair back. But let's take a look at an example. And so Bitwave actually had a very great article about this. They have a really cool DeFi treatment where you can actually categorize all this stuff like right within their UI. And so the first one I have up here, let me zoom in a little bit. This is us actually entering the pool. And so I'm putting in a wrapped Bitcoin and a wrapped ETH pair, and I'm getting an LP token back. In SushiSwap, they call it an SLP token. And so this could be viewed as a trade, right? Because I'm putting 2 tokens in, I'm getting 1 token back. Could be viewed as an exchange, taxable gains. This is the more conservative view, by the way. Okay, so that's step 1. Now step 2, I'm staking my SLP or my LP token, and you can see that's an outflow. Step 3, I'm earning sushi rewards because I'm yield farming right now, basically. And so I've unstaked my SLP token, and at the same time, I've gotten some sushi rewards. Cool thing about Bitwave is that you can actually categorize your sushi rewards immediately within the UI. Basically, the rule of thumb is that anytime you're earning new tokens through any sort of liquidity providing, they're like LP rewards. Those are taxable as ordinary income, and I can just call it income, call the sushi income right in the UI. All right, and then the next part, this is me unwinding my position. So I'm putting my SLP token back in. I'm getting my original pair back. Again, this could be viewed as a trade, right? Because I'm putting 1 token in, getting a new token back. So capital gains applies. And so this isn't really great from a tax perspective because let's say you have a really low cost basis of the assets you're putting in. That could be a really big gain or loss that you've got there. And so there is a more aggressive position you could take, which is saying when you enter and exit a pool, that's not actually taxable. But what you have to do then is basically measure all the gains and losses that are happening in the pool at the time your position is active. And so you're basically recognizing mini gains or losses against people trading on your tokens that you've staked. And so that's fine. It's just really complicated to track because a lot of these DEXs don't provide great reporting. And so if you can swing it, great, but it's just really hard from a reporting perspective. All right, so hopefully I didn't totally lose everyone with that, but I want to jump into protocol and liquid staking, because of course that's very relevant for Ethereum with the merge and everything like that. So protocol staking, let's say that I'm running an ETH validator and I send 32 ETH into the Beacon deposit contract. Good news is that that's actually not taxable. It's more of an internal transfer, because I'm not getting another token back, right? I'm just putting 32 ETH into the contract. I own that ETH. I can't really access it, but it's mine. So that's great, non-taxable. But since I'm a validator and I'm validating transactions, I am earning staking rewards, and so that is taxable as ordinary income. Liquid staking is kind of the same thing. Think of like a protocol like Lido or something like that, but the only difference is that when you stake your ETH, you're getting another token back. You're getting the ST ETH or staked ETH. And again, that could be an exchange, a trade, which is taxable, capital gains. So just something to note there. So again, the treating staking rewards as ordinary income is the more aggressive position or the more conservative position. But there is a more aggressive position which says staking rewards are not taxable upon receipt. They're more taxable upon disposition. And you're basically saying staking rewards are more akin to a stock split, but depends on your risk appetite. Okay, so gonna skip NFTs, but just real quick, wanted to go into setting up a crypto subledger. And when I say subledger, it's a giant database, basically, where you're plugging in all your different crypto activity. And there's a lot out there. It can be very overwhelming. So TLDR, there's a lot of options, but choose a subledger that fits your activity the most. And so you really have to evaluate, like, what different networks am I on? Am I just on ETH, but am I also on, like, Polygon? Am I also on, like, Flow, Cosmos chains? Because each of these subledgers supports different networks. And also, what's my activity? Am I mainly doing DeFi? Am I a validator? Am I NFTs? Like, what are you actually doing? Because I find each of these different subledgers has different strengths, and you really need to evaluate holistically. Like, what are you doing to see which subledger best applies to you? Okay, so real quick, just wanted to get into the quick and dirty guide of setting up a subledger. So step one, where the gleaming arrow is, you want to import all of your data into the subledger. So I mean all of your wallets, all of your exchange activity, any custodians you're on, basically put everything into this database. Step two is cleaning and verifying this data. I have an explosion because this is such a long, like, laborious process, and it takes forever. Let's say you're on a chain that's had, like, multiple upgrades, and it's like, well, and, like, the first chain or the first version doesn't actually have any data, then how are you going to find that? Okay, so I have to get off stage now, but I'm so happy to be here today. Scan this QR code. You can find out more about Hashbasis and how we can help you with your crypto tax and accounting. And the slides are also posted on our website. So thanks so much, everyone.